Hello everyone and welcome. In this lecture, we are going to discuss International Standard on Auditing 315, commonly known as ISA 315. This standard is all about how auditors identify and assess risks in financial statements before performing detailed audit testing. Starting off with the definition, ISA 315 is an auditing standard that requires auditors to identify and assess risks of material misstatement in financial statements. What is a material misstatement? A material misstatement means an error or fraud that is significant enough to influence decisions made by users of financial statements. These risks may arise due to fraud, such as intentional manipulation, or error, such as mistakes in calculations or system failures. The key message of this standard is that auditors must first understand the business properly before deciding how to audit it. So, why is ISA 315 so important? First, proper risk identification helps auditors plan the audit more efficiently. So instead of checking everything equally, auditors focus more on areas with higher risk. And second, this ensures that the audit effort is directed where problems are more likely to occur, such as complex estimates, inventory, or revenue recognition. In simple terms, ISA 315 helps auditors work smarter, not harder. Okay, so adding more to the significance of the standard. So, this standard is important because it helps auditors first understand the entity and its environment. So, before checking the numbers, the auditor needs to know how the business operates, its industry, internal processes, and external factors. Second, it forms the foundation for risk based auditing. Instead of checking everything randomly, the auditor focuses on areas with higher risk of material misstatement. The standard also improves audit quality by encouraging auditors to concentrate on key risk areas. So, when auditors focus on high risk transactions, judgments, or estimates, the chances of detecting material misstatements increase, leading to more reliable audit conclusions. And lastly, it supports compliance with professional standards and ethical requirements. So, by following this standard, auditors ensure that their work meets international auditing standards and maintains professional responsibility. Okay, so what is the objective? The main objective of ISA 315 is to enable the auditor to identify and assess risks of material misstatement. So, to achieve this, the auditor must understand three things: the entity itself, the environment in which it operates, and the internal controls used by the management. So, without understanding these areas, it is impossible for the auditor to identify where financial statements might go wrong. Okay, so ISA 315 applies to all audits of financial statements, regardless of the size or the type of organization. It operates at two levels: the financial statement level, which looks at overall risks affecting the entire financial statements, and the assertion level, which focuses on specific account balances and transactions. The standard includes understanding the entity and its environment, assessing internal controls, identifying significant risks. However, it does not cover how auditors respond to those risks that is addressed under different ISA, that is 330, and it does not deal with expressing the audit opinion. Before diving further, these are some important concepts and terms that you need to understand for um, ISA 315. So material misstatement, I have told you before. I will just tell you like small mini examples of them so you can understand them. For example, material misstatement is a company forgets to record a large bank loan in its financial statements. So this can mislead the investors about how much debt the company has. So this is an example of material misstatement. The definitions you can read from the slide yourself. So internal controls. So only, for example, in a firm, only the finance manager is allowed to approve payments and a different employee records them. So when the duty is segregated, so this reduces the chance of fraud or errors. Inherent risk. For example, a company deals in complex financial instruments like derivatives. So even without mistakes or fraud, these are naturally more likely to be misstated. And then comes the control risk. So a company has, for example, no review process for sales entries. So errors in sale records may not be detected on time. So this creates control risk. Hope you got some idea. Okay, moving forward, what are the auditor's key responsibilities? So under ISA 315, auditors have several important responsibilities. They must obtain a detailed understanding of the entity's operations and industry, the regulatory and economic environment. Auditors also need to evaluate the design and implementation of internal controls, not just assume they work. They must identify significant risks that require special audit attention and apply professional judgment and professional skepticism, meaning they should question information rather than accept it blindly. Finally, all risk assessments and conclusions must be properly documented. Okay, let's go through them with the help of a practical illustration. So, imagine a manufacturing company that has introduced a new automated inventory management system during the year. This change creates a business risk because new systems can have setup issues or data processing errors. The risk identified here is inventory valuation errors. So, under ISA 315, the auditor responds by understanding how the new system works, identifying inventory valuation as a higher risk area, assessing whether controls over system inputs and outputs are properly designed. This shows how understanding changes in operations helps identify audit risks. Taking another example for fraud risk. So, suppose management is under pressure to meet profit targets and intentionally overstates closing inventory quantities. So, this inflates the profits and misleads users of financial statements. Here, the risk identified is intentional overstatement of inventory, which is a fraud risk. ISA 315 requires auditors to apply professional skepticism, identify inventory as a significant fraud risk, consider whether additional audit attention is required. This aligns with the standard's focus on identifying fraud risks arising from incentives and pressures. What are the common errors and risk areas? In practice, auditors sometimes make common mistakes when applying ISA 315. These include over reliance on prior year risk assessments, inadequate understanding of internal controls, failure to identify significant risks, and weak documentation. And the consequences can be serious. Ineffective audit procedures, higher detection risk, and even an inappropriate audit opinion. So, at this stage, the auditors should focus on areas where risks are more likely, such as complex transactions, estimates, or areas prone to management judgment. ISA 315 encourages auditors to constantly reassess risks as new information becomes available during the audit. To summarize, ISA 315 focuses on identifying and assessing audit risks. A strong understanding of the entity and its environment is essential. The standard forms the foundation for designing further audit procedures under ISA 330. So, if auditor gets ISA 315 right, the rest of the audit becomes more effective and meaningful. That's the end. Thank you for listening, and I hope this explanation helped clarify ISA 315 for you. Bye.